Good afternoon, everybody, and welcome to the latest Institute of Financial Accountants Saudi Arabian CPD webinar. It's a pleasure to welcome everybody this afternoon. I hope everybody's keeping well, and I hope you enjoy this afternoon's session. I'm joined by Mr. Sulman Aishan, the Institute's international representative for Saudi Arabia, and I'm also joined by today's guest speaker, Mr. Ali. My name is Jonathan Barber. I'm the Head of Business Development for the Institute of Financial Accountants. Before we introduce the guest speaker today, can I just run through a couple of slides for members and non-members? I wanted to start by just um, mentioning for non-members joining us today who the Institute of Financial Accountants are. The Institute are a internationally recognised professional accountancy membership body. We are full members of the International Federation of Accountants, IFA, who are the global standard bearers and regulators of the accountancy profession globally. That provides the Institute and our members with recognition. The Institute was formed just over 100 years ago, and over those 100 years we have developed, but we have a key core focus, and that is to put accountants, finance, audit professionals, tax professionals who work within an SME sized organization, so a small or medium enterprise, or an SMP, a small and medium sized accountancy practice first. That's because we believe the career guidance, technical support, and the information that you require is very, very different. So we focus as an institute at the SME and the SMP end of the accountancy finance marketplace. If anybody as a non-member is interested to find out more about membership, please do contact Mr. Sulman Aishan. He will be happy to deal with any queries or questions. The Institute in these COVID-19 times are running a number of online CPD webinars. Hopefully a number of you joined us the week before, but just after today, please do join us. We have a UK branch meeting next week. That's on the 9th of June, where we are looking at sales valuation and maximising the sales value for anybody selling a business or a practice. And then on the 23rd of June, a topic I think that has global significance, that is around cybersecurity and how that impacts accountants. Please register for those events using the Institute website, www.ifa.org.uk/CPD. Both of those events are free to attend. We are then holding later on this year the first IFA Virtual International Conference. The date is the 25th of November 2021. We will start to release information with reference to topics and speakers over the coming weeks, but it is and it will be a conference, a virtual conference for all members and all accountants around the world. The topics will be relevant wherever you reside. Just let me cover some housekeeping ahead of today's webinar. This session is recorded. Any technical queries, please bear with us and we will try our utmost to resolve those as quickly and as efficiently as possible. Often though, we found that people have their own connectivity or Wi-Fi issues, which is why they might be experiencing some technical issues. Please do check your own connectivity. Questions, we welcome your questions. And on your screen, there are two ways of doing that. There is the Q&A facility, and there is also the chat facility. Please use those two facilities to ask any questions today. Enough from me. Let me hand over to Mr. Salman Aishan, the Institute's international representative for Saudi Arabia. He will act as host for the session. And thank you to Mr. Ali for his time, his efforts, and his contributions today. We look forward to hearing his talk shortly. Salman, I will hand over to you. Thank you very much, everybody.
Thank you so much, Jonathan. I believe everyone can hear me. Good afternoon, everyone. So again, we are last time we run one webinars on stock markets. So today we are focusing on the topic global interest rates and FX outlooks. So we have a very specialized speaker for that, Mr. Ali Merchant. Let me introduce himself. Uh, Ali Merchant, basically, he has more than 20 years of experience in financial markets, sales, trading, research, as well as relationship management, technical analysis, training, and fintech digitalization as well. His extensive training and trading knowledge in the area of technical analysis, investment management, and advisory and capital markets. Ali Merchant, mashallah, is known as an excellent mentor and has trained more than 2,000 users in across the world. I can say in Canada, Saudi Arabia, Bahrain, Muscat, it's almost whole GCC and Pakistan markets. Mr. Ali Merchant, he has a thorough knowledge of definitives regarding econ and electronic trading, forex trading, dealing and matching further, as I told, FX related, all the detail and technical knowledge. Then Bloomberg terminals, CQG and e-signal products. So mashallah, his experience is wide in all these areas. He has been also working with the Thomson Reuters covering North Americans, GCC and Pakistani financial markets. Prior to joining the Thomson Reuters, he held various roles at Macallan and Day Capital Partners. In Basically, this Macallan Day Capital Market is assistant portfolio manager, as assistant portfolio manager managing North America and global equities across the I can say Toronto and Canada. Then he had been a treasury corporate and HNI sales roles with Saudi Hollandi Bank in the treasury department and breached the information system. Uh, Formally, we call it Dow Jones Tolerate. Ali is also a CMT charter holder since 2002, as well as he's a certified Refinitiv product user and Bloomberg certified user. He is, mashallah, has a diversified experience and in products, technical analysis, daily and weekly reports for the, I can say, Breach News, Chicago Bureau, and updated TA daily views on Bloomberg and Reuters while working on the treasury side. He has worked, as I mentioned, he has worked in Southeast Asia, North America, and GCC. So it's a well-versed, experienced speaker we have today. So we believe that everyone will get maximum knowledge for their practical exposures in the interest rates as well as FX outlook. So welcome, Mr. Ali. Yeah, I'm leaving it to you. Thank you. Thank you, everyone.
Thank you, Salman. Thank you, Jonathan and Salman, for the introduction. I am really privileged to be presenting today with the panel of IFA. Uh, 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 good afternoon, good morning, good evening, whichever time zone you are in. I believe most of the guys are from GCC and Pakistan, and mostly from actually Saudi Arabia. So let me share my screen. Okay. One second. So can I stop? It's asking, Salman, it's asking me a question. This will stop others' screen sharing. So I say yes, right?
Yes, only myself and you will have a full control.
Okay, so I'm saying yes. Now, guys, you should be able to see my screen, and let me know if you are not able to see my screen. Let me move this here. Let me just do some organization on this side. So, okay, 1 second, guys. All right, I will put the chat box on the right. Uh, okay, and one more thing, right. Okay, guys, thank you very much for joining the session today. I am pretty sure that it's going to be one of the key sessions and one of the impactful session today. As Salman has introduced myself, so by designation I'm CMT, and CMT stands for, it used to stand for Chartered Market Technician. Now the organization is known as CMT Association. It's a US based organization, global organization. It's like CFA. It has the similar pattern. You have to do 3 years of, you have to do 3 levels, and then you have to do the sponsorship to get the charter. So I've been associated with this organization, with the CMT organization. Earlier it used to be known as MTA organization since 1997. So it goes back about 24, 25 years. Right. Now, uh, this is something I would definitely like to share with you guys. By education, I am Bachelor of Technology. So I was nowhere, I mean, when I started my career, I was nowhere close to the financial market. And I came to the financial market, and I would say it was just an accident, right? And now you guys are basically from the accounting profession, finance and all. So, you know, the key terminology or the key words which our world of finance revolve around is profit and loss. Now, it's very funny. When I started my first job in my I mean, I initially started in Pakistan, in Karachi, with Reuters, the Reuters news agency, or Reuters financial information company. So that was my first interaction with the financial market. I was dealing with the different dealers and all and what I found interest in the financial market, and I started looking at the financial market. And the first thing what I did was the that I started looking at the price history and price patterns, right? And the one of the strange thing, which actually every move has a motivation. What motivated me to the market? And as I said, that we revolve around the world of finance, and a world of finance is between a word profit and loss. My motivation was a loss. So what happened? I took a first trade, a first equity trade ever in my life in Karachi Stock Exchange market, and I lost my 6 months of forward salary. And that was my motivation point. And that actually that incident triggered a challenge in myself, that how is it possible that a person can lose so much of his future income? That triggered me. I started looking at technical analysis. Again, from Reuters, I gave up my technical career. I moved into stock market with different brokers for 5 years in Pakistan. Uh, I came to Saudi Arabia in 1998, and the reason I was hired by Dow Jones Telluride, it was my technical analysis skill and my association with MTA. I came to Saudi Arabia in 1998 with Dow Jones Telluride, served Saudi Arabia from the financial information, business development, from the perspective of technical analysis. We used to have a product by the name TradeStation. So I used to I was basically the business development manager for a trade station and in Middle East and North Africa. Moved on further. As I mentioned, that I worked with a lot of banks in between. So I'm just giving you a little bit of brief introduction of myself, and the events happened, and that triggered me to where I am today. Right? In between, what happened was Dow Jones Tolerate was taken over by a group, a Missouri-based group in the US, Bridge Information Systems. Now, Bridge Information Systems was a combination of many companies, but there were two key companies. Was one of the company was Knight Ridder. It was actually Knight Ridder. It was actually, I think, an Asian or Australian-based company. And Knight Ridder had a very good team of journalists. And when the entire company came into being, the name of the name of the company was set to Bridge Information Systems, and that news agency for Knight Ridder was actually changed to Bridge News. I got an opportunity to work with Bridge News Chicago Bureau, covering the markets like Euro, Swiss franc currencies, German bond futures. And funny enough, or strange enough, I was covering Dow Jones and S&P and NASDAQ index sitting in Riyadh. So I was working in a different time zone. While sitting in Riyadh, I was working the North American time zones. So move on forward. I got an opportunity with Saudi Hollandi Bank. You know that those who are from Saudi Arabia or GCC, they know that basically Saudi Hollandi Bank was ABN AMRO for Saudi Arabia. So I worked in the treasury on the prop trading for almost a year, and then my bosses, they decided that they thought that I have got more sales skills and I should be part of the sales team. So I have the opportunity of serving the corporate treasury and high net worth individuals in Saudi Arabia between the time of 2003 and 2007. One of another incident, and this is my observation, or I call it I say it in such a way that it's when you are in the Middle East, you get this, I call this one as a fever. It's Canadian fever. I got this fever since 2004, and then I decided to move on, and I moved to Canada. And something again funny enough to mention, and I would say it was a completely out of even I never thought of that this will happen. What happened is there's in all Islamic countries I lived or worked, Pakistan, Saudi Arabia, I was working in conventional banking and interest rates bearing instruments. In Canada, I landed a job with Islamic Sharia fund. So there was a good 2 years with them. So we were covering, actually, we had the opportunity to serve these ethical or socially driven funds. And we were covering North America, Canadian market, North American market, and we had an income fund as well. So that's where, and then I joined Thomson Reuters. So I had a good 11 years with Thomson, 11 and a half years with Thomson Reuters. And now recently I'm more into consultancy. So I'm doing consultancy. And one of my assignment these days is I am part of Saudi Kuwaiti Finance House in Riyadh. Now, Saudi Kuwaiti Finance House is basically it's a CMA company, and basically what my role is I look after the liquidity fund, Bait liquidity fund, which is a money market fund or Islamic money market fund, and we have DPMs from mostly it's the insurance and leasing sector companies. So that's where I stand today. And again, I'm not giving you any sales pitch from my company, but just to give you, Saudi Kuwait Finance House specializes in trade finance fund. So we have not a public, but it's a closed-end trade finance fund, and DPMs and liquidity, the money market fund. So here I am today with you guys, and it was like, I had an opportunity to speak with Salman somewhere 2 months ago, and we agreed this date. And here I am in front of you. So here, I mean, you have to listen a lot from me. This is what, here I am. This is, you have been through it. Now, the topic, let me set up the expectation.
Sorry, Ali.
Yes.
Yeah, kindly, if you make it a full screen in the presentation mode,
Sure.
just press F5.
Sure, I'll do that. 1 second. Let me go here. Okay. Can you see now?
Yeah, just you have to do one more thing.
Like,
There is a like screen button. You can hide the notes slides something.
okay, 1 second. Where do I hide it from? Let me just see. Okay.
Yeah.
Does it do? No. This is actually more slide options. Okay, let me go here. Screen, and then actually black screen, white screen. That's what I can see.
No, just a second. On the top, there is a display screen setting as well. Display setting. Yeah.
Okay, 1 second. Okay, let me go here, and it says duplicate slide, swap presenter.
No.
There's only, I have one option is swap presenter and duplicate slideshow.
Yeah, you can try this one, top one.
So it's duplicating the entire screen.
Now is it okay? Yeah.
Can they see? Because I'm seeing. Okay, 1 second. Yeah. Okay.
Oh, I think it's
So
fine.
it seems fine. Okay, so let me just minimize this. Okay, so here I am. So let me. Okay. Let me go back to the previous slide. Okay, so let me set up the expectation. The theme for today's presentation is, I'm going to start from give you, some of you may know about what technical analysis is. I will give you a little brief history of technical analysis and what technical analysis is. Then we are going to talk about the interest rate outlooks. And I will give, before I start, I will give you some financial terminologies, which I'll be talking about. And then we are going to get into FX, and I have added some more for you guys. A little bit on the oil market, a little bit on the gold, right? So let's go. Now, technical analysis is actually, see, technical analysis, I use technical analysis for the timing tool. In the world of financial market, we are benchmarking ourselves, our performance of the portfolio, or whatever we are doing against a benchmark. So sometimes it's benchmarks against S&Ps. In the case of Saudi, it is benchmark against the Dawul. So performance against how the performance of the portfolio versus the benchmark. So technical analysis, I use it for timing tools, beating the benchmark, beating the market. So timing is critical in our life. Everything, we start our day at a certain time, we go to the office at a certain time, or we do our task based on time. So we are basically time-based human being, where we have meetings on time and all this. And timing is everything. When to enter and when to exit. What is our strategy? So that is all about it. And technical analysis is used to generate extraordinary gains, outperforming or beating the market. So here, I think I believe that you guys have gotten the gist of the subject, what subject is. Now, what exactly is technical analysis? Technical analysis, these are the 5 best definition I got it from books. Study of data generated by the action of market, the study of data generated by the action of market, the study of behavior and psychology of market participants, graphical picture of market sentiments, analysis that studies demand and supply based on price, studies and volume. The last one is the very impactful, and it has very depth meaning. Technical analysis is a psychologist. So just to give you a few things, a few words, anything we do in the financial market is based on demand and supply, or mostly what we deal with is demand and supply. In the sense of financial market, if the demand and supply is reflected in the prices. Right? Now, I'm trying to explain you the fifth point, which I have put it on my presentation, that the technical analysis is a market psychologist. Anything which has happened that is already reflected in the prices, what technical analysts do is trying to figure out what has been reflected in the prices. So demand creates demand, prices go higher, supply creates supply, prices goes down. That's why I believe technical analysis is the market psychologist, because he is looking at the psychology. Now, all these price action is historical. So he's looking at the historical psychology to see what are the future trends, right? Again, good timing tools, fundamentals makes the bigger picture. Technical are used for timings and generating extraordinary gains out of the market. So I would like to make it an interactive session. So if you have any question and if you want me to clarify during this presentation, please do interrupt me. Otherwise, you can hold your question until the end, because generally I like to make it an interactive session, right? Okay. Now let's move forward. Now, again, technical analysis is a tool to identify market trends, right? Now, there have been like for they have been actually and it's a very old subject. I mean, it goes back about more than 150 to 160 years. Japanese were the key inventor or the drive behind this subject. Japanese rice merchants were there in 1850s and 1857. They used to predict the future price of the crop. Now, there are geometrical patterns which appears on the market. There are continuation patterns, reversal patterns. So that is known as classic technical analysis. There's another one that I actually classify it in three main subdivision. So one of them is classic charting, where I try to draw, or we as a technician or we technical analyst try to draw some patterns on the market, which I will show you in a bit. Indicator-based market. Indicator is like, let's take an example. You are driving a car. So the driver actually is a human being. So far, we don't have self-driven cars, which is going to be a reality very soon. I mean, there's a test going on a lot, but so just take it an example as a driver is driving the car, and driver gives an indicator that he wants to go to the right and that he wants to go to the left. So driver is the main, which is the price action in terms of technical analysis or financial market, and driver is giving the indicator. So indicators are the support to price action, whether the market is going north or whether the market is going south. And then we combine all these strategy, and there's another one where within technical analysis is cycle-based analysis. Some of you might have heard about Elliott wave analysis. Sometimes you might have come across that Dow Jones as a 35 years of a cycle in one move from a bottom to top and come back. The entire cycle completes in 34 years. So that sort of thing. Now let me move ahead. Okay. So today's topic on where it comes to on the interest rate basis, guys, one second, let me just go back. You guys can see my screen, right? Now at the top, I'm seeing this ribbon from Zoom. Salman, is there any way I can move it? Because I'm
Yeah, sorry.
Are you guys seeing this ribbon at the top, participant stop video or something? Or are you seeing
Yeah, there is a view option on the top, I believe.
One second, let me go here. Okay, so basically I go to
just click on the participant. Might be it will remove for you. Click and then again click like 2 times.
Okay.
Or on the top right, there is another option would be view.
Okay, I think the chat probably. Okay, there's some question in the chat. Okay, can we get the soft copy? Yes, we will. Definitely. I mean, just check with Salman. I think the video recording is generally available on the YouTube. So okay, let me just, and I will make sure that I'll share with them with Salman, right?
Yeah.
Okay. So the topic is Interest rate outlook. Now, being in the financial industry, we are exposed to capital expenditure, capex. We are exposed to borrowing. There are, I mean, these days the corporates have high commitments on delivering whatever they are. If they are into manufacturing, if they're into services, if they're into IT, whatever it is. So they are leveraged when it comes to the projects they are
Hello.
committed. Hello, can you hear me? Hello.
Hello. I didn't see your videos. Huh?
I am sharing the screen, so maybe there's something wrong at your end.
No, nothing. I'll check. You just carry on.
Okay, right. So the thing is, corporates are leveraged. They borrow funds from the banks to run their business. Right? Now, interest rate is the key. Interest rate has been lower. It's lower. So for quite a long time. The other thing is, if you guys have, there was like I think in the month of April or May, Janet Yellen, who is the Treasury Secretary for the U.S., she came and she said the interest rate has to rise, and that create a havoc in the market. I mean, the financial market and everybody went to their started investigating that how much is going to impact them, this and that, and then there was a crash in the U.S. market. The entire global equity market crashed. So interest rate is definitely a key topic. So what I'm going to cover is I'm going to show you the trend, what is happening in the interest rate market, comparing 5 years interest rate swaps versus 3 months LIBOR. Again, same thing for Saudi Riyal, 5 years swap versus 3 months SIBOR, 3 months SIBOR and LIBOR spread analysis, 3 months US dollar LIBOR historical pattern, and 3 months SIBOR historical pattern, 3 months. So these are the topic I'm going to cover in terms of the interest rates. So let me go further. Okay. The financial terminology which I'm going to use is LIBOR. So I mean, most of you guys are aware of what LIBOR is. LIBOR is London Interbank Offered Rates. This is the minimum rate which a bank charges to, basically this is the minimum rate with interbank rates for the interest rate market. Then SIBOR is Saudi Riyal Interbank Offered Rates. Now, when you borrow something in LIBOR, so there is a margin on top of which where the bank charges you, so LIBOR plus something. It depends on the credit quality, what sort of credit quality is. If Aramco goes to borrow something, they may get a lower margin. They will be able to borrow at a lower margin over the LIBOR, SIBOR or LIBOR. Then I'm going to use one terminology which is interest rate swap. Now, interest rate swap, what is from the corporate perspective, especially from the finance and you guys and CFOs and the perspective, you guys are a borrower of money from the banks. Now, there is one way is you pay based on every 3 months basis. Every 3 months basis, the bank will see what the 3 month SIBOR rate is or the 6 month SIBOR rate is. Whatever the benchmark it is given against, the loan is given against it. And then you pay the differential. There's another terminology in the market. There's another instrument in the market is to hedge your interest rates. So you can hedge your actually borrowing cost. Now, interest rate swap works two ways. Either you pay fixed versus the benchmark, which will be the variable, or you pay variable against the benchmark, which is fixed. It depends what is your outlook about the market. So if I think the interest rates market is going higher, I will do a swap to pay fixed against variable. But if I think the interest rate market is going down, I will sell the interest swap in order to receive fixed, pay variable, because the markets are going down. So it's the differential of fixed and variable. So variable is SIBOR or LIBOR. So if LIBOR is going down and I have a fixed, I'm hedged against the fixed, so I get the difference as long as the LIBOR or SIBOR is going down. Right? And then we will do the spread analysis. Spread is basically the difference between the two instruments. Right? So let me move into the next one. Now, guys, if can you see my slide clearly? This is actually this is actually it's 5 years. It's there are two charts on it, and then there's just a spread at the bottom. The one which is in amber, which is in orange, is actually 5 years US dollar interest rate swap. And the one in purple is 3 months LIBOR prices, historical prices. I am comparing this one from 1987 all the way until today. I have taken these screenshot this morning, so it's very fresh. I mean, very fresh in the sense it's up to date. Now, you will see a trend. So I have overlaid those two charts on one price scale. Whenever, now see here, whenever orange drops below the purple line, orange is 5 years interest rate swap, and purple is actually the 3 months LIBOR rate. So what we have seen when the orange drops, that means swap, when the interest rate swap goes below 3 months LIBOR, the market sees a series of interest rate cut. So the central bank cuts the interest rate, the drop in the interest rate. Now, the scenario which I'm focusing here is whenever the difference between the two is huge, eventually what happens is swap markets starts to give us a signal that the market is good, the Fed is going to rise the interest rate, or SAMA is going to rise the interest rates. So here we have seen this scenario in 1993 and 94. So if you see from the interest rate perspective, from almost 3.5 to double. Purple is again 3 months LIBOR. So from almost 3% to 6.5%. Similar scenario happened when it started declining. Swap went below 3 months LIBOR, and we have seen the interest rate going down. On the up, once the market consolidated, there was a huge difference between the swap market and the 3 months LIBOR. And eventually what happened was swap started going higher. Market started predicting, or market started forecasting that the interest rates are going to go higher. And that's what we have seen here. Right? Here, this is the basically 2008 financial crisis. The interest rates were zero for a very, very long time. And then again, see, we had this in 2014, we had this build up again. The swap market started going away from the much, there was a huge difference between the swap and 3 months LIBOR. And then eventually what you've seen is after a little bit of a move down on the because of the financial crisis, and Fed was actually stimulating the buying bond strategy and stimulating the economy. Once again, swap came down, and then eventually interest rate has gone higher. Now, focus please here. We have a similar setup building up now, right? That setup is suggesting that there is a huge difference between the two. Yes, there's been stimulus going on. Fed has been supporting because of the COVID since March last year. They've been buying bonds, helping corporates and all. But there was one signal given by so central bank looked at the inflation. Inflation is at the super high at the moment in the US, and that came from Warren Buffett. That came from Janet Yellen, right? She said something in April, I think it was late April or early May, that the interest rate has to go higher. And then the market was like, went both ways. I mean, the financial market dropped, technology dropped, especially in the because the technology is more borrowing and spending, right? So they borrow a lot from the banks. Now, basically I mean, in the technology sector, I mean, if you take Apple and all, they're heavily cash rich, but the newcomers startup, they rely a lot on the borrowing. So technology side dropped and all those things. And this build up on the chart, the difference between the 5 years interest rate swap, which is going higher, and LIBOR staying almost near the 0% or 0.25 basis point. This price, what you're seeing, 0.13, is the mid price. So generally the market looks at the mid price. So that is suggesting that there is something happening in the interest rate market. So that is one thing. Let's go to the next slide. This is exactly what we have seen in the previous one was 5 years US dollar swap versus the 3 months LIBOR. This is the Saudi Riyal version of that. 5 years Saudi Riyal interest rate swap versus 3 months SIBOR. Again, we had the huge difference here. SIBOR gone higher. We built up in 2008 after the financial crisis. We had the similar setup here. It's gone higher. We are building up the similar situation here as we have seen in the previous slide. Sorry. Yeah. Here, this one. So it's basically showing us the similar situation in LIBOR market and SIBOR market, because the dollar is Saudi Riyal is pegged against the dollar. So any move in the Saudi Riyal in the US interest rate market is reflected in the Saudi Riyal market. So I hope we are clear up till here. Let me move to the next one. Now here, what this is the spread analysis. The spread analysis between 3 months SIBOR versus 3 months LIBOR. 3 months SIBOR is in the actually orange or amber color, and then 3 months LIBOR. Let me go back previous. And 3 months LIBOR is in the purple. Now, where I'm focusing here is whenever there was a difference of, huge difference below between the two, the spread between the two, like SIBOR was higher than LIBOR by about 75 basis point, and that spread goes narrow, about 66 basis point or 60 basis point, the interest rate market goes higher. So that happened here in 1993-94. That happened here, this place. That happened here. Slight higher. Again, we had this similar situation here. We had a similar situation in 2015. And now we are exactly doing the same. So out of 1, 2, 3, 4, 5, 6, 7, and 8, 6 times the interest rate has moved higher when the spread narrowed between the 3 months SIBOR and 3 months LIBOR by from a huge difference of say 70, 80, 90 basis point to coming down to 60 basis point. So this is basically, if you see this is the 58 about 58 basis points, right? So that is also indicating that we are at the lower interest rate cycle is going to go away sooner. Okay. Let me move to the next one. Okay, this one is 3 months LIBOR, historical price since 1980 all the way until this morning. What it is showing that if I see from 1989, if I see the trend on the chart from left to right, the interest rates have been going down, but not in one single line. It has gone down for a while, moved up. So anything what you do is see is the drop in the red and move up in the green cycle. So what I'm showing you here is the red is the downward interest rate cycle, green is the upwards interest rate cycle. Now, one thing which I am focusing here is the downward cycle. First one was 16 quarters, second one was 14 quarters, third one was 14 quarters. So if you see historically, if I take the average out of this one, 15 quarters of down cycle, we are down since this peak in 2019 for almost 10 quarters by now. And when the move goes higher, we have about 30 quarters of high move on the upside, then 9 quarters. So there is no, there's no what I say similarity in this one. But if you see this move from 1993 to 1998, we went higher. We have moved higher in 30 quarters, and that's what exactly happened in 2000 and from 2009, where we made the low. We were at the interest rate was almost zero. We moved higher by 36 quarters. So that is the trend. I'm just giving you the trend, what the trend is. But the key thing is 14, 16 quarters, 15 quarters of down move. We are already done by 10. So if we say, suppose 5 more to go, so we are talking about somewhere after middle of next year, the interest rates are going to go higher. Right? That's one assumption from what I'm seeing from the technical charts. Same thing now we are going to Saudi Riyal, Saibor market, 14 quarters of down move, 31 quarters of up move. This is a quarterly chart. 10 quarters, then again 20 quarters. So there is no similarity when it comes to the down move. 20, 15, and 14. So it's always above 14, between 14 and 20 quarters. Right? But the up move is 31 quarters, again 10 quarters and 29 quarters. So here is the similarity. So it seems like, again, if I look at the dollar direction, dollar LIBOR direction, it seems like we have a couple of more quarters to go for zero interest rate. And eventually the interest rates are going to go higher. That's what central bankers are indicating. Inflation in the US, also inflation in Saudi Arabia is picking up. So that is also indicating that probably we are very close. I mean, we have actually most likely bottomed out in the interest rate market for now. The swaps are going to go higher. So if you want to hedge yourself, you will be buying some costly swap going forward, expensive swaps. Second thing is, once the interest rate moves higher, it will move higher quickly, right? So we are near. So the conclusion is we are near the end of, or we are near or close to the lower interest rate cycle. In a couple of quarters, maybe from 3 to 4, maybe 5 quarters, the interest rates are going to go higher. Let me move further forward. Now, what I'm showing you here, this is the US dollar 3 months LIBOR. Whenever the interest rate bottomed out and moves higher, so in terms of Fibonacci, let me just, okay, 1 second. Previous. Okay. Okay, 1 second. So thank you very much, whoever said that it's a new experience. So this drop from 1989 to all the way 1992, when the interest rate moved higher, it moved higher in Fibonacci. We do the Fibonacci retracement tool. We Fibonacci, what are the possibilities of when it moves higher? Again, Fibonacci itself is a huge subject. What are the possibility of when it moves higher? Where can it go? So one of the level in the Fibonacci is 50%. And I have seen that whenever the interest rate cycle has moved higher, it has either gone to 50% or above 50%. So in this downward move, when it picked up, it went to 50%. Now here you see previous bottom became the next resistance. Same thing here, dropped, moved higher by 78.6%, between 62 to 78.6%. Previous bottom became the next resistance, right? So here we are actually, if you see, technically we are basically bottoming out. We are making a base pattern. We have multiple attempts to actually test this level in the past more than 11 years, right? Now, if this previous model is right, that means if the market goes higher, where it comes into in terms of US dollar LIBOR, which is now at almost 0.13, yeah, almost 0.13. If it goes higher, it can go to 1.5%, 50%, which is the minimum target. See what's seeing the historical prices. This is in terms of actually LIBOR. Okay, let me just see. So this is in terms of basically LIBOR. Right? Let's go and see SIBOR. 1 second. Let me go to the previous slide. Okay, yes, this is SIBOR. Next. Okay. In the terms of SIBOR, when it dropped, the first time it came back between 50 to 62%. Second time when it moved back, again, see the similarity, 50 to 62%. Third time, same. Third time, actually, if you see, again, 50%. Second time, it was above 62%. First time, it was between 50 to 60%. So in the case of SIBOR, once it bottoms out and it moves higher, we are talking about, now the SIBOR is 80 basis point. We're talking about 2% or 200 basis point to 2.25%. And when it happens very quickly. See here. So from 1993, by 1995, by the end of 1994, we were from 3% to almost, 6.5%, and then we went to 7%. So see how quickly when it moves into the other way around, when it moves increasing interest rate cycle. Right? Let's go and see the next one. Now, this is the US Treasury 10 years yield. And I have taken this one as the monthly chart. Now see here how the Treasury yields were holding until March 2020. It was holding a base around 1.60%. 10 years yields were 1.60%. Until 2000 and what do you call it? 1 second, actually. Okay, so until 2000 and March 2020. So now it dropped, came back. 160 or 150 is the baseline for now. So I'd say it's 142 actually. So 142 and 142.50 is the baseline for now. And as long as it remains above this, there is a threat that Fed may act much earlier than what the charts are showing is 4 quarters more to come. Fed may act earlier. It may make a base around 1.40. Now, technically, what we think is, what we say, it was a double bottom or a triple bottom. This bottom has been breached. We've come again this one. Now, this line becomes a very key pivotal line. If it holds for next few months above this is a monthly chart, 1.40, I think Fed will act in the later part of this year. We might see an interest rate hike by Q4 this year. And historically, Fed has started increasing the interest rate in the second half of the year. So the first time they started in 2014 and 15, it was for 15, I believe. They started in June. So keep in mind, basically we are in the month of June. So anything happening in the Q3 is pretty unlikely, but there is a possibility that something happens in Q4. All the technical indicator, which is relative strength index, is suggesting that the interest rate market is going higher. 10 years yields are going higher. Moving average convergence and divergence, which is popularly known as MACD, that is also suggesting that the MACD is divided into positive cycle above zero and negative cycle. So MACD is pulling out of the negative cycle. Let me close this if I can. Okay, anyway, it's frozen. So MACD is pulling out of it's in the negative cycle, but heading towards the zero, neutral line. Right? Okay, let me go to the next one. Okay, yeah. So the next one is basically, so this is what the outlook of actually interest rate markets, right? So we're basically the treasury yield, 10-year treasury yields, as long as it remains above 1.40, which I think it will, we have a threat. As it moves higher, Fed will be forced to increase the interest rate, and the interest rate might go higher. As the historical charts were, I showed you on the historical chart that basically we still have 4 to 5 quarters, but there's a possibility that we may not have a lot of time left. Probably we have 1 or 2 quarters, or end of this year, we might see the first rate hike. Right? So let me go further. Next. Okay. Now, in this one, we are going to talk about the dollar index, euro, sterling, Swiss franc, Canadian dollar, Brent future, oil future, and gold. So let me move forward. Okay. Now, what I have taken here is the US dollar index. Now, what is US dollar index? It is the weighted average of these currencies. So the weighted average, the weight on this one from euro is almost 57%, 58%. Japanese yen has 13%. Pound is 12%. Canadian dollar is 9%. Again, this is a little bit, I think, the older one. Swiss franc has, Swedish krona has, SEK has 4.2%, and Swiss franc has about 3.6%. So look at this quarterly chart. We were actually, the dollar index dropped from 1990. It's somewhere in 1985 to 1992. falling interest rate market for almost about 30 quarters. Then the upward move from 78 to 112, 121 was 36 quarters. This was the rising interest rate market. So the currency works on if the interest rate of the currency is going higher, that currency is being bought. That currency is being that is kept in the portfolio, and the currency prices increases. Same thing, we dropped for 26 quarter. So 30 quarters here, 26 quarters here. Again, we have seen almost from 121 to 71, right? Here we were 78, we made a new low in the index. Then we have 35 quarters of move up from 2008. Again, 2008 was the beginning of financial crisis. Yes, there was no interest rate hike from 2008 to 2014. But as I said, that basically when the interest rate moved higher, one second. When the interest rate moved higher, it moved very quickly, and we have seen the strengthening of dollar. So dollar was in the range on a very long-term basis, and then the dollar has strengthened. So if you see, it's an 8-year cycle here, almost 8-year cycle here. Say, take it from 1992. From 1992 to all the way to 2000, it has gone higher almost 8 years. 8 years of higher interest rate, 8 years of lower interest rate. I mean, I'm taking from the point when the interest rate was at the most lowest to the highest, and there was no increase after that, right? So same thing, I'm taking it from here. 2008, yes, the interest rate were at the lowest, but there was no hike until 2014. So interest rate remained the same for a very, very long time. And then the hike came in 2015. So this 8-year were the strengthening of US dollar. Now, from 2016, the interest rates have remained stagnant, and then eventually interest rate has gone down, right? Now, keep in mind, we have a double bottom scenario on the US dollar index. So it made a low somewhere in 2018. It tested the same low in 2020, and actually in basically in 2021 as well. So this pattern looks like more of a rectangular pattern, which suggests that the dollar will rise. We will have some interest rate hike, and then eventually the dollar will go down, because dollar for last 20 to 25, 30 years has an 8-year cycle. So if this cycle has started in 2016, that means technically 2020 should be the end of the weakness of dollar. So that's what it looks like to me, right? And now if we compare the downward move, we had 30 quarters here, 26 quarters here. So far we have done 17 here. So maybe some sort of a pullback and then down. This pullback will be most likely supported by the hike in the interest rate market. Okay. So let me go to the next chart. 1 second. Now, in terms of euro, so recently this is euro monthly chart. Euro tried to break 123.50 twice since Q4 or Q3 2020. It failed. It tried here, dropped, came back to 118.19, tried again. Now it has failed so far. I mean, for last 2 months, this is a monthly chart. For last 2 months, it's just contained. Like last month, it remained below 123.50. This month, so far, it's remained below 123.50. If it remains below 123.50, there is a threat that euro is going back to 116, 117, or 118 level. One of these technical model stochastics is suggesting that the market stochastics is continuously going higher while the market was going higher, going higher. It's stochastics continuously going lower while the market was going higher. Perfect bearish divergence. Relative strength index is also this technical model is also supporting that when the market has gone higher, its RSI was going down. So relative strength index suggests that probably the euro has a downward move, which is supported by a higher move in the dollar index, which is supported by the hike in the interest rate, what we have seen a little bit earlier. Right? Let me go to sterling. Sterling is also in a similar situation. Around 141, 142, sterling failed here, came down. Again, we tested this one. Are we coming down? It looks like most likely. We have a similar, our stochastics model is suggesting that when the market was going, prices were going higher, stochastics was going down. RSI is very almost flat. And we have seen historically the same pattern here. Failed to break, we came down. So that means, again, this agrees with strength of dollar and increase in the interest rate market. Let me go to the next one. I just want to make sure that we finish within 1 hour. So let's see. This is the weekly chart for dollar Swiss. Now, in the dollar Swiss scenario, because it's dollar Swiss, that means if the prices are going higher, that means in the case of euro and sterling, is 1 euro is equal to so many dollars. In the case of sterling, 1 sterling is equal to so many dollars. So in the case of sterling and euro, if the prices goes down, US dollar is strengthening. Same thing in euro. Prices goes down, US dollar is strengthening. Let's go next. Let's go next. In the case of sterling, because it is $1 is equal to so many euro, sorry, in the case of Swiss franc, $1 is equal to so many Swiss franc. Any increase in the prices means the dollar is getting, they are getting higher. Now, what we have seen in the terms of dollar Swiss, this is the resistance and support line. It was a support here. It was a support here. When it dropped, we have seen dollar give weakening. When it moved higher, it moved higher. When it came down, it has come down. Now there are key levels in Swiss franc, almost 0.92, 0.94, and 0.96. Right. Our technical model, slow stochastics, is rolling over. That means it's suggesting that the move is towards the stronger dollar. And then the RSI is also rolling over, supporting prices to accelerate. Prices acceleration means dollar strengthening. And then we have a very nice trend line which is holding from this low to here, and then we have actually what we call it in terms of candlestick pattern in the technical analysis. These are two hammers. So hammer, actually market is being hammered to go higher. So that means we are seeing, again, this is also supporting the dollar is going to go higher. We will see Swiss franc, which is now about 0.90 to go to 92 and 93 soon. And it will, once it closes above this resistance line, it will actually go to 94. Right? So let me go further. Next. Dollar yen. Now the key reason I'm showing you so many charts to identify, excuse me guys, to identify the trend. Interest rate market is saying that the interest rates are going to go higher. That helps the dollar. I mean, US dollar interest rates are going to go higher. That helps the dollar. Dollar market is suggesting, currency market is saying that the dollar is likely bottoming out. It's going higher. That is complementing the interest rate outlook. And the thing is, if you see dollar yen failed to break 109 or 110. I mean, it dropped to 110, and then it's now hovering around 110. Went up to above 110, but failed to hold it for the next month, next week, and dropped. And now we have almost 2 weeks of closing above 110. Stochastics model suggesting higher dollar. RSI suggesting higher dollar. When I took this screenshot, we were about 110. So we crossed 110. We will go to 112. Again, higher the number on the right-hand side scale means higher the dollar increasing. So this is also supporting the idea of dollar strengthening. Let's go to the next one. Dollar Canada, which is my favorite because I have to track dollar Canada, and some of you on this panel in this group may have expenses in Canadian dollar. So I have a similar situation. So in dollar Canada, see the stochastics making a U-turn. Right? Again, if you see, a bottoming formation in RSI from very oversold levels to moving higher. And we have a hammer. This hammer suggests that the current move, which was it was about 121 a few minutes back, a couple of hours back, it can go to 125 easily. But the trend, if you see from left to right, is still down. It needs to clear at least 130 for the dollar to become into a bullish cycle. As long as it's below 130, the dollar is in the weakening cycle on a very longer term basis. But on a medium to short term basis, the dollar is oversold. The dollar needs some pullback. The dollar needs some strengthening. That it works very fine with, if I go back here, with my dollar index scenario. Dollar going higher, dollar index going higher, which means this currency will be weaker, and then the dollar comes down. So that agrees with that. Let me go to next. Okay. So we have seen Japanese yen, again Canadian dollar. Let me go to next one. So Canadian dollar, I hope it's clear up till here. Let me go to the next one. And this is the Brent future, oil market, weekly analysis. Now, if you see a point to note, an observation here, 72 has been a key level on Brent. Above 72, it has gone higher. Above 72, it has gone higher. Broke through 72, it has gone down. 72 came down. 72, bigger move on the downside. This is Q. This is the March drop, March and May drop, when the Brent is the UK version of the oil. When the crude, which is the US version of the oil, dropped into negative by, it was negative $40, right? Now, see here, the range is, it's coming back to the same level, 72. Yes, if I look at the outlook coming from the banks, they're talking about it's going to 80, this and that, but my charts are not suggesting that. My charts are suggesting 72 is a key obstacle. If it crosses, yes, it's going back to 80 plus. Maybe it's going into much higher, around hundreds, right? But if it does not cross, oil is coming to 56. And if you see the trend on the slow stochastics, it's continuously, markets going higher, slow stochastics is going down. From this top, lower top, lower top, and lower top. While my market has higher high, higher high, higher high. Typical bearish divergence. Right? Now, oil works inversely proportional to dollar. If the dollar is weaker, oil is higher. If the dollar is stronger, oil is lower. So that means, again, this is supporting three key points. Interest rate to go higher, dollar to go higher, interest rate to go higher, which will support the strengthening of dollar. Oil to go down, dollar will go higher. Right? So we're coming back to the same conclusion. And I have the final slide for the day, which is next. Okay. This is gold. Now, something very interesting in gold. Gold had from 1990, 85 to 97 gone higher, then flattened, very small range where it comes to higher time frame between 498 to 251 for a very, very like 80s, 90s until the beginning of 2000, when the US started Y2K, bubble in the economy, bubble in the stock market, and then dollar collapsed, interest rate started going lower, right? So look at here. This was a very strong cycle from almost 251 to 1920, right? Now, from 1920, it has come down to 1045 way back into 15 and 16. The key important thing where I'm focusing is 1920. We tried to break 1920. This is a quarterly chart. So 3 quarters back, we failed. We tried again. I mean, we did go higher about it. In the same quarter, we went higher, but it's close below. Second quarter, we went higher, close below. Third time, we dropped big time. This time, in this quarter, which is basically the Q2. We did test a couple of days back 1900 plus, but again we were back when the last I checked the price, we were back below 1900. So that means this is suggesting now gold prices works inversely when it comes to dollar prices. If the gold is higher, dollar is weaker. If the gold is down, dollar is stronger. So point to note, interest rate market looks like going higher. That supports dollar strength. That supports weakness in the currency. That supports weakness in the oil market. And gold finding strong resistance in 1920, that supports that the dollar is going higher. So if we take all these 5 points, it seems like interest rates are, the conclusion is the interest rates are going to go higher at some point, either later this year, early next year. Dollar strengthening in the meanwhile, uh, oil going down, gold going down. So everything is pointing towards one thing: stronger dollar, stronger interest rate, oil down, currency is weaker, and oil, gold to be weaker. So I think, let me go here. So this is where we conclude. I will open for the Q&As. And okay, 1 second. Let me see on the Q&As. Okay, I think how are we managing by time? Okay, it's good. How much? Okay, now I'm taking the Q&A, and then I'll ask Salman to open for the Q&A. What is it? Okay, there are 3 more. Sorry, 1 second. Something in the chat. Let me see in the chat. Okay, this is basically Abdul Kareem. When it comes to the recorded session, Salman will take care of it. He will help you out. Does the chart help us to evaluate digital currency also? Yes, the chart can help as long as any instrument, a liquid instrument, has the historical prices. Yes, I have done a lot of analysis on Bitcoins. What I am doing is actually I am helping financial traders on how to look at to learn technical analysis. I do a lot of sessions with the guys on different market outlooks and all. So I will share my contacts. Feel free to reach out to me, and I'll explain you how the digital currency can be technical analysis can be used on the digital currency. Please put your question and answer. Okay, that's what's from you. Okay, anything else? Voice issues. Okay, even okay. Babu, even though it is a new experience, it's very interesting. Okay, it's interesting. Please share the webinar recording. We will provide. Okay, so that's what's the communication between. Okay, now let me take something on the Q&A and let me go to the next slide.
Yes, Ali, I'll read all the questions one by one.
Sure.
So you can.
Sure.
I'll appreciate all other participants if they want to have the like typed questions, or if they want to have audio, we can turn on the audio for them and they can have a live questions. So I'm taking one by one. I just noted down some questions.
Sure.
The first of all, the first question is basically one gentleman had 3 questions.
Right.
So how has the forex market changed post pandemic? So if you and should I read other 2 as well, or you will first answer this? Yeah.
No, it's okay. I think it's better if you can read all 3. So I will see if there's any similarity between the 3 questions.
How has the forex market changed post pandemic?
Right.
There is more. Is there any more uncertainty now? And the third one is, are there any indicators that support the moving trend?
Okay. So how has forex market evaluated evolution of forex market after pandemic? See, now let me answer this question. Forex market has been less volatile. Why? I'll give you the reason. Because what happened was the digital economy and the digital or crypto side of the market has more volatility. Now, if you see euro, let me do one thing is, Salman, I need your help. How can I go back and 1 second, let me just close this. What I need to do, okay, 1 second. previous. What I want to do. Okay, so I'll answer you, and
just
then I'll
remove the full screen.
Yes,
You
that's
just
what
remove the
I'm.
full screen, then you can go to relevant particular slide.
Yeah, 1 second. Where do I do that?
Just
one?
press
So,
escape.
escape. Okay. All right. Okay. That is great. Right. So let me just. For some reason, this one is frozen. Okay. So let me do. Okay. Okay. So the first question: what has happened in the forex market? Is forex market? If you see, let me bring a chart for you here. Okay. Let me do something if I can. Okay. Something is all right. I hope it does not slow down my machine, but anyways, okay. Let's see. I will take something like, okay, just a second, guys. Give me a few minutes to get back to my chart. Okay. Now, this is the Euro monthly chart. Okay. Okay. This is the Euro quarterly chart, right? If you see the volatility, this is nothing in the euro compared to like the low. If you 2020, okay, if you see the low was about 110 1.09, and the high is about, it's the volatility of 20% or a little bit around 20% in post I mean, in COVID, I would say from 2020 to till now, right? This is nothing. See the volatility here. 3 quarters from 137 to 104, right? So the volatility in general has died down with the digital cryptocurrency. The volatility is very high in the digital currencies. Let me take a chart. Let's see. We all look at Bitcoins. 1 second. Let me bring it. BTC. Okay. Now see the volatility in the Bitcoins. Okay, why? Okay, this is, I'm trying to take the daily, weekly. Okay. This is the weekly chart. Let me go and see the monthly chart. Now, let me change it to candles. Anything in the red is the downward move. Anything is green is the upward move. See the volatility. Since the volatility has shifted into digital currencies, cryptocurrencies. That's why the forex market has been a little less volatile, and volatility has been picked up into digital currencies and stock markets. Let me take, say, S&P, because that's one of the gauge for.
I think, Ali, we can say pandemic is not an exact reason for the volatility.
In a way, but a little bit, the volatility in the currency market is a little diminished actually, but it has been picked up in, what do you call it, in the crypto digital currencies, digital assets, right? So what was the second question? Sorry, I slipped out.
Yeah. The second is, there is more uncertainty now, or it is recovering basically.
In what sense? Uncertainty in what sense? In the financial market?
Forex markets.
Forex market, okay. Forex market, I mean, see, uncertainty is the darling of volatility, because if there's an uncertainty, there's volatility. When something comes up, definitely things actually move in one direction. When it comes to uncertainty, I don't think forex market has been working the same way. It happens that sometimes it's basically thin market, and sometimes the volatility increase, and it moves basically two ways, right? I believe that what I've seen on the charts and what I've shared with you, I'm very clear that the next few months or next few months is going to be the month for the dollars, and the dollar will be strengthening. So I mean, I hope that answers your question. And what was the third one?
Are there any indicators that support the moving trends?
Well,
in terms
actually,
of Forex?
one of the key moving trend is the uncertainty in the interest rate market. So on one hand, the inflation is super high. I'm talking about the US market. And on the other hand, the interest rates are too low. So when this connects, there's a disconnect between the economy, higher inflation, lower interest rate. When we go back to the normal mechanism, higher interest rate, higher inflation, higher interest rate, that will actually, that is one of the threat and the indicator in the market. Yeah.
The next question was, please explain a little bit about Fibonacci.
Fibonacci. Okay, Fibonacci is basically it's a number. We have mathematical number 1, 2, 3, 4, 5, 6, 7, 8. Right? Fibonacci number is a series. The gentleman behind Fibonacci is I forgot the name of the guy, but he came up with this series. I can always find it out. The series is 1 plus 2 gets the next number 3. Now 3 plus 2. So if you look back, current number, add it with the previous number, gives you the next number. So 3 plus 2 is 5. So it's a series of 1, 2, 1, 2, 3, 5, 8, 8, and then 13, 21. So it's a series, and it's being followed in the market, especially in the financial market, to identify the trends and see how what the next level of correction would be. And this is also followed in the nature. 0.618 is a golden ratio. So the pyramid in Egypt, I think the length of the pyramid is 0.618, if I'm not wrong, 0.62%. And even in the human nature as well, 0.618 is a golden ratio, and 1.618 is also a key ratio. If you guys are interested, we can do a session on technical analysis, because it's a very, very long subject. But again, Fibonacci, just to give you the idea, it's a number series. Yeah.
Okay. Yeah. Thank you.
Yeah.
The next is, if any person or company would like to invest in Forex, then what would be the best currencies, and from where they can get some statistics?
I mean, a company
Or individual,
now.
if they want to invest in Forex
Okay.
currencies.
Okay. Now, the thing is, actually, the web is full of information. There's a lot of information available. There's a website by the name fxstreet.com. You'll find a lot of information about the Forex. Now, as a corporate, you can do the hedging against some of the instruments you might have. If you have exposure in dollar yen, you have exposure in Swiss franc or euro. If I were the person, though I'm not an investment advisor, and this whole session is for education purpose, if I were doing it for myself, I will expose myself more in dollar. So if I have any exposure against dollar, I will hedge it from the corporate perspective. From the personal perspective, I will keep my assets in dollar for now. I mean, until the dust settles, the dollar interest rates going as we have seen the outlook for the dollar interest rates going higher, gold going down, oil going down. That suggests that the dollar is the asset to keep, right? And please, if you guys, just to I mean, just to emphasize here, these are my contacts, guys. Reach out to me. My mobile number is here. I'm available on WhatsApp. My email is here. My LinkedIn profile. If you want to know more about the FX market or any financial market or technical analysis in particular, I am available. Right? Okay. What's the next question?
Yeah. Okay. Do you believe USD will weaken further as compared to Pak rupees in short-term future, and will it strengthen in the long term?
Okay.
Your two cents in yeah.
Okay. Now, something very strange about Pak rupee is basically move against the entire trend. So if the dollar is stronger against the all currency, it can be weaker against Pak rupee. And then I can show you on basically here, right? So see Pak rupee. Now, what I will do is I'll try if I can get the US dollar index on it, and you will see yourself the, okay, this is here. Let me try and, okay, give me a minute. I will change it to the line chart. Okay. And again, seeing is believing, right? So once you see something, you will actually understand what's happening. So let me go to the analysis. Okay, one second. See if in the meanwhile I'm working on it. In the meanwhile, you can, if there's any other question, please, I can focus on the other question as well.
Okay. Should I ask another? Should I?
Yeah, please go ahead. Please go ahead.
Yeah. Okay. Does these charts help us to evaluate the digital currency also? I think you have answered for this.
Right.
Could you please list down these charts name? I think it's there on the top left. Every chart name has, or on the presentation you had the name on every
Right.
chart.
Exactly. So see here, this is Pak Rupee weekly PKR, weekly chart. So it's there. At the I mean, you will, on your presentation, you will be seeing this.
Yeah.
Right.
Okay. Meanwhile, the next is how forex rate affects interest rates, bond yields, inflation in general.
Well, the key driver is the interest rate. It's not the forex. I mean, see, higher the interest rate, that currency is being bought.
Mhm.
Right? Lower the interest rate, that currency is being sold. So the key driver is interest rate. Now, bond yields, so interest rate is the driver. So interest rate goes higher, interest rate of US dollar goes higher. Say, for example, dollar will strengthen, right? Second thing is, once the interest rate goes higher, the bond prices will come down. So interest rate is inversely proportional to the bond prices. The yields on the current bond will go higher. Right? Now, I'm coming back to the dollar index versus PKR, the guy who asked me this question.
Mhm.
So the dollar index going higher, I mean, this number going higher means dollar is strengthening. See here, in terms of, again, PKR was weakening here because PKR is inversely proportional, right? But when the dollar index actually drops, see the drop here? This is the weekly chart. It does not reflect in the PKR. So PKR has completely different mechanism. Now, if you see, dollar has weakened against all the currency, which you see here. We have seen some in the PKR. So, I mean, sometimes it's directly proportional, sometimes it's inversely proportional. Right? I hope that helps.
Yeah. Yeah. So the next question I think is relevant to the same our like this PKR and USD. Like, are the political reasons can impact these FX and interest rates?
So see, the effect. I mean, financial market is sensitive to everything. Where it comes to, if there's again, where it comes to dynamics of economy, GDP, micro and macro data, where it comes to politics, where there is a geopolitical issue, where there is a threat of war. So if you see what happened in the oil market a few months ago, that a tanker got stuck and the oil market shot up. An event has triggered. So any event can trigger a move in the market. Yeah.
Okay, yeah, that's it from my side. So any other participant, if they want to speak, so we can open up the video. You can raise your hand.
So any
Okay,
question, guys?
anyone? Okay, so I do not see further question.
So thank you very much, guys. Thank you very much for time. Definitely, we have gone over an hour.
Yeah.
It's almost not 30 minutes more than that. Apologies for that. Salman, I will share this presentation with you. Feel free to share with the guys. Recording is already there, and I will appreciate if you can share the recording link with me, so I can keep it for my future.
So we have one more question.
Sure.
Digital currency will help us to do the future payments.
Well, actually, see, whenever the technology has been invented, I mean, if you see, go back 200 years ago, in 1920 was the era of industrialization. Industries flourished for next 100 years. Year 2000 was the era of technology. Technology has flourished. We are working, I mean, 1920, 30, 40s, we were doing the accounting on the ledger, manual ledger. Now we are doing Excel and all those, right? Industry now is the era of digitalization on artificial intelligence. I am pretty sure that the digital currency is going to be, I mean, whether how it works in our normal life, but it is going to become an asset going soon. There will be all the fund managers, those who have missed, even some people, they don't believe in it, but crypto or digital currency is going to stay. It will be recognized as one of the asset, because the blockchain technology behind is going to keep this technology alive.
Yeah. Okay. So I can say some closing remarks. Like I was impressed, I believe our participants as well, on the technical statistics available with you, and your professional attention to develop all those thorough analysis indicating the future trends. It was, I can say, a great session to transfer the technical knowledge on interest rates and FX global outlook. I believe most of the participants would be dealing with these things, with these particular trends in their on their jobs. So I can say thank you so much, Ali, for bringing your expertise and experience in this regard. And we had a fruitful session, and I learned a lot about the FX and interest rates. I'll thank you all the participants to be part of this event, and we will announce the further events soon. You can see on the screen information, contact information of Mr. Ali. You can also contact him if you need any further opinion about or trends if you want to discuss. Video recording will be available on the IFA YouTube channel, I believe maximum by Monday. So I'm just in the chat, I'm mentioning the YouTube channel name. It's Institute FA. So I just mentioned, you can all follow this channel, and you will get the video of this session. Okay, the one last thing is, Jonathan, are you here with us? Okay. Thank you.
Sorry, Sulman, yes, I'm here.
Yeah. So, and any closing remarks from your side?
No, I'd just like to thank Mr. Ali for his presentation, the detail and the information he shared with the audience. Thank yourself for your continued efforts, and I just wish everybody a good afternoon, stroke evening, and look forward to seeing everybody very soon on the next webinar. Thank you all.
Just to add two words from my side. Thank you very much, guys, for giving me the opportunity. I really enjoyed it thoroughly. Thank you very much for the participants, and appreciate your efforts. And feel free to reach out to me. You have my contact details. In any way I can help. I do a lot of consultancy. I do trainings on technical analysis and all those stuff. And anything I can do professionally, personally, please feel free to reach out to me.
Ali, we have two more questions if you would like.
Sure.
Tokir, I'm allowing your audio. You can ask your question. Tokir. What are the benefits or drawback of low interest rates? Will it help us to control the inflation as well? Like especially Pakistan's perspective, they asked question.
The benefit of the low interest rate is the corporate activity, industrial activity, business activity flourishes. One thing. On the lower end, from finance and banking perspective, the banks and finance institution, they don't make a lot of money. Where it comes to on in the individual investment, what it also impacts us, because low interest rate does not pay us on any fixed terms or fixed interest based instruments. I think that the things come to my mind.
Okay. Thank you, everyone. Thank you so much, Ali, for your.
Thank you very much. Thank you
Thank you.
very
Good
much.
evening. Bye, all.
Bye. Take care, guys.